So the first thing we want to remember is that we're in a macroeconomy, that we have our aggregate supply and aggregate demand. And if we take an example here, we're currently in equilibrium. This is our initial demand, AD, aggregate demand. And demand and supply come together here at P1 and GDP level 1. And these levels here, this level of GDP is less than full employment GDP, which is much higher. This means that we are below full employment, and that we probably have cyclical, or we do have cyclical unemployment. And our goal would be to, well, we can wait for the economy to move towards full employment GDP, or we can push the economy forward with demand. Somehow we can push demand up towards a equilibrium here where we'd be at full employment. Now we'd probably have inflation as well because we'd be driving up prices at this new equilibrium to the right, but we'd solve our unemployment issues and we'd be at full employment real GDP. Now the way we do that in macroeconomics is through two different types of policies. The first type of policy is fiscal policy. So fiscal policy looks at taxes, so to what extent the government can increase or lower the different taxes it has at the different levels of government, and to what extent it can increase or decrease expenditures, for example, on education, on military, on infrastructure, major expenditure areas for most national, even local and regional governments. In terms of monetary policy looks at to what extent we can actually modify the amount of money in an economy. And by modifying the amount of money in the economy, we can also influence demand for goods and services. And we'll see that in a separate chapter. But for the moment, we're going to focus on fiscal policy and how fiscal policy can impact aggregate demand. But before we get to the actual policy, let's get a better understanding of what is a government budget and what are the sources of revenue that exist. So a budget, just like you and I, the government has a budget, an annual budget, and this annual budget records the flows of revenue coming in and money going out in the form of expenses. And when the revenue coming in to the government is equal to the expenses going out, we can say we have a balanced budget when annual government spending and taxes, tax revenue, are equal. This is not always the case. In fact, it's rarely the case. And in most cases, the revenue coming in is less than expenses going out. And in this case, well, we have a deficit. We have something missing. We're spending more than we're getting, so we have a budget deficit. And this is when the government spends more money than it receives in taxes in a given year. Now, we can have the exact opposite when revenue is greater than expenses, and that would be a budget surplus. And like I said, this has happened in the past, and we do have periods when the government is in a surplus period. But for the moment, most national governments, at least, are running in deficits. So what's happened with the annual deficit in France? Now, I can show you the annual deficit in the United States, and your textbook shows you that, but let's take a look at the deficit in France over the last several years. And what we see is that the deficit goes up and down. Here we have a very, very big deficit. This is a negative number here. This is negative 6% of GDP. So here we have more than 6% of GDP. This is almost negative 8%. So we have 8% of GDP is the deficit of the state in 2010. So deficits, you know, a bigger negative number, well, for some reason the government had to maybe relaunch the economy, or we did not have sufficient tax revenue. Same thing here. And usually, and this follows basically what we see in economics, is that the deficit's going to probably get bigger, or a bigger negative number, when we have to relaunch the economy. When the deficit here is relatively small, well, that means that the tax revenues are probably close to, we're almost at a balanced budget here, close to what we have to spend. And as you can see, since 1970, there's been very few times when we've actually had a surplus If 0 here means we've balanced our budget as a percentage of GDP, we can see there's just been very few periods of time when we've had a budget surplus since 1970 in the French economy. Well, revenues, the first thing we want to look at, come from various sources. And taxes, in this case we can look at the United States. Federal tax receipts represent about 20% of GDP. Okay, and these taxes take many forms, and we see all the different forms here of the different taxes. Let me give you an understanding of these different types of taxes. The first type of tax we have is an individual income tax. This is a tax based on the income of all forms received by individuals. So if you're an individual and you receive wages and salaries, if you receive interest income, if you have capital gains incomes, all of these are annual income, a flow of income into your household, which can be taxed, and that's the income tax. The second type of tax we have is the payroll tax. This is a tax based on the pay received from your employer, and they're usually used to cover Social Security, Medicare, which is kind of like healthcare, is a healthcare system in the United States. Now, payroll tax is called a payroll tax because it's deducted from your pay. It's deducted from your salary when you earn your salary. Some of it is paid by you. Some of it is paid by the employer. There's a sharing part going on. If you're self-employed, you pay both parts. So it can be quite an expense. Now, we say it's shared by the employer and the employee, but we're smart economists, and we know that if an employer is paying part of the payroll tax, most likely the salary that they pay us is also reflecting the fact that they have to pay payroll tax. So we can imagine that we're probably having lower salaries and lower wages to help finance the employer's share of this payroll tax. It's not as easy as we think. Corporate income tax is typically taxes that corporations pay on corporate profits. In a lot of economies, this can run between 20 and 33% of corporate profits. It's not the income. Corporate income tax is not really based on the income, the revenue they make, but it's based on the profits they make. So income less expenses. The excise tax is sometimes called a sin tax in some countries, is a tax on specific goods like gasoline, tobacco, and alcohol. And in France, for example, we have specific excise taxes on energy products. We also have taxes on alcohol. We have taxes on tobacco. And these, as I said, in some cases are called sin tax because they're usually ways we push people not to consume certain items. And we won't go into the discussion about how they're imposed, but usually they're linked to items that have a tendency to have a high degree of inelasticity. And so we do see a change in the consumption, not much, but it does generate a considerable amount of revenue for the state. And lastly, we can have estate and gift taxes. And estate taxes and gift taxes are taxes that we pass on the taxes on the assets of individuals when they move from one generation to the next. So if you were to inherit money from somebody, then that would be taxed. Now, estate taxes vary from country to country. In the United States, for example, the estate tax basically is zero unless you inherit something like $2 or $3 million. That's not the case in France. In France, we have an estate tax, which I think is around 20 to 30%. And it starts at a very you can inherit, I think, 100,000 euros without paying estate tax, but beyond 100,000 euros, you must pay estate tax. Now, if we look at France in 2019, France brought in 281 billion euros in tax revenue, and you can see how this was divided up. The value-added tax is a tax on the sales of goods and services, and it's the final consumer that pays that tax. It's not on intermediate goods and services, but on final goods and services sold, and that represents this value-added tax, or VAT, as we say in English, or TVA in French, this VAT tax represents 56% of revenue, tax revenue, in France today. So it's a huge amount. Income taxes only represent 26%, so a much smaller share than what we see in the United States, where the income tax, for example, is a major source of income for the government. Afterwards, corporate income taxes, energy tax, so this is an excise on energy products, inheritance taxes, and capital gains tax. Now, I'm not going to get into the debate, but some people may say that the value-added tax is not a very fair tax. Income taxes tend to tax people who make more money will pay a higher income tax, and we'll see why in a minute. Value-added tax, if you go out to buy a loaf of bread, or if you go out to buy a product and somebody who makes €1 million goes out to buy the same product, you're both going to pay the same value-added tax. And so the VAT tax for some people is not considered a very fair way to tax people because everybody pays the same amount. And it's a point of debate. Taxes have specific characteristics, and specifically income taxes. So income taxes can take many forms. We can have what's called a proportional tax, and it's also called a flat tax. And a flat tax basically says that we're gonna have everybody who makes income pay X% of their income in income tax, regardless of the level of income. This is the simplest income tax to administer. And many countries have tried to move towards a proportional tax. However, the tax systems are extremely complex and difficult to change. Filling out tax forms can take days, if not weeks, to get right. It's a very complex process, and so many countries are looking at establishing a proportional or flat tax to eliminate all of the administrative costs of taxes. But this is a long ongoing debate to put into place proportional or flat percentage or flat tax. We also have regressive taxes, where taxes, in fact, for high incomes will pay a smaller share of their income. But in most countries, we have what's called a progressive tax, where the tax that's collected will increase the percentage of your income. As your income grows, the percentage tax you pay will also grow. So the more money you make, the more you pay, and the higher rate you pay. And this is represented through what we call marginal tax brackets or marginal tax rates. So here we have the marginal tax rate system that exists in France today. So we have different brackets of income, which you see over here. And here are the brackets, the total annual income for each bracket. If somebody were earning 50,000 euros per year, for example, their last 50,000 euros, the last euro earned would fall into this tax bracket here. Okay, so let's see how tax is actually calculated with a marginal tax rate system like this. So we have 50,000 euros that somebody's earning. The first 9,964 euros are not taxed at all. So this is zero tax. Okay. The next block of money, anything earned between 9,965 to 27,519, is taxed at 14%. So that equals 17,555 euros. And what's remaining, well, the 22,481 will be taxed in this bracket here at 30%. So what does that mean in terms of revenue collected? It's pretty easy to calculate. We calculate zero. We get zero revenue from this first block. We get 2,458 euros from this second block. And we get 6,744 euros in revenue from this third block, coming to 9,202 euros in taxes paid. And so you can see the marginal rate increases as we get higher levels of income. The average tax rate, which is the amount of tax we paid divided by our income, is about 18% in this case.